Now that you have an understanding of how an index fund works in a retirement account, let me show you the breakdown of a target date retirement equity-based index fund, ETF, and an actively managed fund, and show you how they perform and reallocate every year and how they're different from one another. I'm going to use Schwab, Fidelity, and Vanguard to do some comparisons. And to be completely transparent, I do not own any of these funds. And the first one I'm gonna go over is the target date retirement fund, because I get questions from you in the comment section all the time if the target date retirement fund is right for them. The first thing I wanna make sure of is that I choose the right target date retirement fund based on my age. So if I'm turning 60 around the year 2060, retirement 2060 fund might be the right one for me. There are other target date funds all the way from 2020 to 2070. So this is the classic invest and forget investment strategy for those who don't want to pay too much attention to the allocation, because it does the reallocation for me every year. And the first one I'm going to go over is the Vanguard Target Retirement 2050 Fund. How can I tell this is an index fund? The first indicator is the expense ratio right here at 0.08%. So for every $1,000 I invest in this index fund, Vanguard will charge me 80 cents. That's extremely cheap compared to many actively managed funds. But the easiest way to tell if it's an index fund or not is right here where it says management style. And this target date fund requires an initial investment minimum of $1,000, and it pays 2.05% in annual dividend yield, where it says a 30-day SEC yield. And let me click on portfolio composition right here. This target retirement fund 2050 is diversified with 4 index funds, and about 55% is in the Vanguard Total Market Index Fund, 36% in the International Stock Index Fund, and 7% Total Bond Market Index Fund, and 3% in Total International Bond Index Fund. So that's a total of 90% stocks and 10% bonds. Whoever's in charge of this index mutual fund doesn't pick and choose stocks in this portfolio. It just automatically reallocates every year towards more bonds and fewer stocks as years go by. But here are some downsides of owning a target date retirement fund. One, I don't have any control over how I want to allocate my stocks and bonds. This mutual fund is completely in charge of reallocating my investments. Two, because this is passively managed, the allocation only happens once a year. So if the stocks are down, the mutual fund will still sell those stocks at a loss because it's following the annual allocation arrangements or schedules. And 3, the target date funds have historically underperformed the market index because of the automatic reallocations. There's a lot of data that suggests investors should have higher equity allocations during economic downturns or recessions than during expansions. I did this during the bear market in 2022 when the stocks were down significantly from their all-time highs. The target date funds will only give you the index allocation target that it's designed to do. But again, if I'm the type of person who wants to invest and forget, then the target date retirement fund might be the right one for me. And the next mutual fund I'm going to show you is Vanguard Wellington Fund Investor Shares. The expense ratio for this is 0.25%, which means that for every $1,000 I invest in this mutual fund, Vanguard will charge me $2.50. And how do I know if this is an index fund or an active fund? The management style is labeled as active right here, while the asset class is balanced at moderate allocation. And if I click on performance and fees, this mutual fund has underperformed the market benchmark with a 9.74% year-to-date return, while the Wellington Composite Index performed a 14% return year-to-date. The overall 10-year average annual returns are about 8.1% compared to 9.08%. However, if I click on portfolio composition, it tells me that this mutual fund is diversified with 66% stocks, 32% bonds, and 1% cash reserve. The market return is underperforming the equity market because it has over 30% bonds in this mutual fund. It's currently investing in 80 different stocks with a median market cap of $169 billion. If I click on the balance tab right here, it tells me that the turnover ratio is about 40%. And what this tells me is that about 40% of investments inside this mutual fund were sold since November 30th, 2022. That's quite a high number, because if I click on distributions at the top, it says that there's already $1.12 per share in realized gain per share. So what that means is that if I own 100 shares, I'm gonna owe taxes on the $112 that this mutual fund has gained over the year. Sometimes it'll say short-term capital gains, but most of the time it'll say long-term capital gains. So remember when I said it's not as tax efficient in an actively managed fund, right? This is what I'm looking at when I do any research on mutual funds. I want to know what the turnover ratio is, because that's how I know how frequently the mutual fund manager is selling stocks inside a fund. And a high turnover rate isn't necessarily a bad thing. It just depends on the type of fund that I'm investing in. Let me do one ETF from Schwab. How do I know if this is an actively managed fund or an index fund? I'm gonna find where it says passive right here under management style. This ETF tracks the performances of Dow Jones US Dividend 100 Index with an average market cap of $148 billion. And when I click on performance here, I'm gonna find how identical this SCHD index ETF has performed compared to Dow Jones US Dividend 100 Index. The year-to-date return is about 1.97% compared to 1.99%. It's not very impressive. However, the 10-year average annual return is still 11.69% compared to 11.79%. And let me scroll down where it says top holdings. So this ETF invests in stocks that pay high dividends like Cisco, Broadcom, Home Depot, Coca-Cola, Chevron, PepsiCo, and UPS. And I can even look at this sector that this ETF is investing in. And it looks pretty well diversified in this ETF. It's spread out between industrials, healthcare, financials, consumer staples, information technology, and many more. And let me go back to fund details of this SCHD ETF and show you how to read and understand what this ETF has. In fund inception, starting at the top left corner here, it just means that when this ETF was born, and it was born on October 20th, 2011. Total net assets is how big this fund is, so it's around $48 billion. And the total expense ratio is 0.06%. So what that means is for every $1,000 I invest in it, the ETF manager is gonna charge me 60 cents. Shares outstanding means the total number of shares issued by this ETF and actively held by the investors who own this ETF. So there are a total of 663 million shares outstanding as of August 22nd, 2023. NAV is the share price, or it stands for net asset value. So $73 or $72.94 is how much it'll cost me to buy one share of this ETF. Total holdings are how many stocks are in this ETF. In this case, it has 104 stocks. The portfolio turnover rate is how frequently this ETF sells its investment. So since a year ago, 28% of its portfolio was sold to acquire different assets. Morningstar category just tells you the asset class Morningstar classifies SCHD as. Morningstar is just another financial services firm based out of Chicago, maybe, or something like that. And management style is passive, which means it's passively invested. CUSIP, this is kind of a nerdy level, but CUSIP stands for Committee on Uniform Securities Identification Procedures. Nailed it. So these numbers are like the unique registration numbers for the ETF to register as a licensed security. So like Apple will have its own CUSIP number and Amazon will have its own CUSIP number. An exchange just tells us where it's being traded, and that would be the NYSE or the New York Stock Exchange. All of this information I'm giving you right now is saving you thousands of dollars with a financial advisor. So be sure to subscribe if you enjoyed this type of content. And this is Fidelity NASDAQ Composite Index, ticker symbol FNCMX when it finishes loading here. So this index fund tracks the performance of the NASDAQ Composite as the benchmark. And Morningstar has this categorized as a large growth mutual fund. And this index fund has been around since September 2023, and the expense ratio is 0.37%. So for every $1,000 I invest in this index fund, Fidelity is going to charge me $3.70 annually. The minimum to invest is $0. Most Fidelity and Schwab index funds don't have any minimum investment amounts anymore, but Vanguard still does. But if I already have a Vanguard Roth IRA, there's no reason for me to invest in the Fidelity index fund or Schwab index fund. The turnover rate for this index fund is 3% as of last quarter. Portfolio net assets is in millions, so it actually has over $13 billion total in portfolio assets. And 12-month low and high just means that within the last 52 weeks, the share price has gone down as low as $128 and as high as $181. The current share price is $171, which trends more towards the 52-week high. Let me click on performance and risks right here. See how this index fund has performed. It's performed about 16% in average annual return for the last 10 years, or about 12% since inception. And this is a high growth index fund for sure. If I scroll down just a bit, it's going to show you how the index fund performed every year. So last year, NASDAQ got hit really hard with a negative 32% return, but it's already recovered by 37% return. This is pretty incredible. This is why I bought so much last year when the market got hit pretty hard. And if you look at 2020, good Lord, it's made a 44% return, and 2019 made a 36% return. And let's go into composition and see what this index fund has. And almost half of this index fund is in information technology. So I want to keep that in mind. Almost 15% is in communication services, and another 15% in consumer discretionary. The rest of the sectors are somewhat diversified. And take a look at the top 10 holdings here. And these stocks matter to how this index fund performs, because 10 of these stocks are 51% of the total portfolio. So Apple has the biggest weight with 13%, Microsoft with 10%, Amazon with 6%, Nvidia with 5%, Tesla with 4%, Alphabet, Google with almost 7% if you combine them, Meta with 3%, and Broadcom and PepsiCo are about 3% total. If these stocks make some big moves, then this index fund will likely make some big moves too. And this index fund concentrates on large cap growth companies with market value greater than $10 billion. So growth funds generally focus on generating capital gains rather than income. If this is an income fund, then it'll be something like SCHD that pays dividends, like I showed you earlier in this video. And as far as asset allocation goes, it has almost 97% in US equity or US stocks and 3% in international stocks. So if I only invest in this index fund, then I'm only gonna be exposed to only stocks with no bonds. And I also want to keep that in mind. And I totally get that this is not easy to read or understand. Once I read it over and over again, I start to see a pattern in every brokerage website. And I realized a long time ago that I don't have to be a professional stock market expert to invest in index funds like mutual funds or ETFs. As times went by, it actually started to become easy for me to read and understand these investment funds. And what I want you to do is take the time to go over index funds you may be interested in investing. And what I don't want you to do is investing something you don't understand, because I've seen way too many people investing in the wrong mutual fund without knowing what they're doing. And I've met someone who invested his entire 401k into long-term bonds without knowing what he was doing. Years passed by, he missed out on 10%, 15%, or even 20% annual gains. So take your time to do your research and download my free financial resources by visiting FinanceShare.com/resources. And if you're curious about your eligibility to join my private client program, you can schedule a free intro session with me by visiting FinanceShare.com/coaching. And this has been another beast of a video, and I hope you got a lot out of it.